Sir, please start.
Good afternoon. Good afternoon to all. Do you have any question, any query from our previous two sessions? If you have, please raise. As we will start our today's topic, income from other sources. The last head of income. In this session, we done salary, we done income from house property, and now we are doing income from other sources. If anyone have any question, any query from our previous session, please raise. Okay. So we are going to start income from other sources. This is the last head of income. We can say this is the residual head of income. If there is an income and that income is not taxable under any other head of income, then surely it would be taxable under the head income from other sources. In spite of this, certain incomes are considered, certain incomes are taxable only under this head. For example, dividend, casual income like winning from lotteries, crossword puzzles, etc., gift, share premium in excess of fair market value of shares. We will discuss all incomes in this. We will try to understand all types of this income in this section. First of all, we are starting with dividend. In general, this is the fifth head of income, residual head of income. If there is an income and there is no head, then that income would be taxable under the head income from other sources. However, certain income which are prescribed under Section 52 shall be taxable under the head income from other sources. Few of them are dividends, winning from lotteries, crossword puzzles, gift, share premium in excess of fair market value of shares, some money amount forfeited by you as an advance received against any agreement to transfer any capital asset, and if you receive some interest or enhanced compensation, it would be taxable under the head income from other sources. Certain income may be taxable under the head income from other sources. These income are not taxable under PBBP, and certain income, if these income are not taxable under PBBP or income under the head salary, then surely it would be taxable under the head income from other sources. First of all, we are going to start dividend. What do you mean by dividend? Anyone? What do you mean by dividend? Anyone have any idea? What do you mean by dividend? Where a company distributes its profit to its shareholders, probably that is considered as dividend. Yes or no? In general, where a company distributes its profit to its shareholders, that may be termed as a dividend. However, in income tax law, that is also considered dividend. Apart from this, certain other payment or distribution are also treated as dividend, which are described under Section 2, subsection 22, 2 block 22. That is also termed as a deemed dividend. If following distributions are also considered as a deemed dividend for the purpose of income tax law. Generally, dividend means distribution of profit among shareholders by a company is known as dividend. In general, as per company law, dividend is supposed to be paid by in cash mode. That means the company is supposed to be paid in cash. Apart from this, certain distributions in certain scenarios, certain distributions are also termed as dividend for the purpose of income tax law. Even though that is not considered as dividend for the purpose of company law, still we will consider those distributions as a dividend for the purpose of income tax law. We are going to understand this. Section 2, clause 22. The following payment or distribution by a company to its shareholders are deemed as dividend to the extent of accumulated profit of that company. First one, any distribution of accumulated profit which results in the release of assets of the company is treated as dividend. So what does this mean? Suppose that there is a company, just a minute. Suppose there is a company and the company is supposed to distribute assets to their shareholders, then it may be termed as dividend if it is the distribution is to the extent of accumulated profit. Assets may be cash, may be kind. If the company is distributing their stock interest to their shareholders, then that will also consider as dividend for the purpose of income tax law. In general, as per company law, distribution of profit is termed as dividend. Generally, dividend may be distributed in cash, but here income tax law is not considering only mere cash. It is considering that if the company is distributing their accumulated profit and the result of that, there is a release of assets of the company to their shareholder, then it would be also treated as dividend for the purpose of income tax law. Suppose a company is distributing equity share, is providing bonus share to their equity shareholders. Is it treated as dividend? Is it treated as dividend? Anyone? A company is allotting equity share as a bonus to their equity shareholders. Is it termed as dividend? Is it termed as dividend? Surely no. Why no? Because by distribution of equity shares, there is no release of assets. Since the company is not releasing any asset in this situation, then that's why it is not termed as any dividend. However, whereas company is distributing their land, their fixed assets, or their stock, then it would be considered as a dividend because the distribution results into release of the assets. That's why it is termed as dividend. Number next. Distribution of debentures, debenture stock, debenture certificate in form, whether with or without interest to its shareholder, equity as well as preference share, and share to the preference shareholder by way of bonus. Now, what happens? Now, suppose there is a shareholder, the company is distributing a debentures to them or a preference share to preference shareholder, then it would be considered as dividend, even though here there is no release of assets. But the company is promising that in future they will release the assets against those debentures or against those redeemable preference shares. Since the company is bound to redeem all these things, so company is taking the responsibility, the company is taking a liability, creating a liability for future, and that will result release of the assets in future. So income tax law is suggesting that if a debentures are provided to the equity of preference shareholder or shares, bonus shares are provided to the preference shareholder, in that situation, these are treated as dividend to the extent of accumulated profit of the company. Even though here there is no release of assets, but still the income tax department is understanding that the company is creating liability and which will result release of the assets in future. So it will be also considered as dividend at the moment when debentures or such bonus share to preference shareholders are given. Be careful once again, equity bonus to equity shareholders are not treated as dividend. Number third, distribution made on liquidation to the extent to which the company possesses accumulated profit immediately before liquidation. Suppose the company is under liquidation and the company is supposed, if the company is under liquidation, they are supposed to distribute their assets among their shareholders to the extent of accumulated profit. If the company is distributing their assets to their shareholders if the company is under liquidation, then it's also treated as dividend. Number next, distribution made on reduction of capital of the company. Suppose company have accumulated profit, and now the company, instead of releasing of the assets or saying that instead of distributing their profit to shareholder, now the company is taken the stand like they are distributing, they are reducing their capital. And in view of that reduction, the company is paying money to their shareholders. In that situation also, our income tax department is saying that since this distribution are made due to reduction of capital, is also treated as dividend to the extent of profit the company have. Number next, 222E. This one is the most important one. This one is applicable only in case of private limited company, that means closely held company. Any payment, whether in cash or in kind, by a company in which public are not substantially interested to the extent of accumulated profit. What do you mean by public are not substantially interested? That means closely held company. That means private company. This 222 clause E is applicable only in case of private company. Remaining A, B, C, and D are applicable in case of all type of companies. Only this part, E part, is applicable only in case of closely held company, that means private company. What is saying that any payment by a company in which public are not substantially interested, that means a private company, by way of loan or advance to its equity shareholders. Suppose a private company is giving loan to their equity shareholders, who is beneficial owner of the share and holding not less than 10% of voting power. Voting power means? That means equity share. By way of any payment by way of loan or advance to the equity shareholders. Which shareholder? The equity shareholder holding 10% equity in the company. If any loan or advance is given to that type of equity shareholder, then that loan or advance to the extent of accumulated profit of the company shall be treated as dividend for the purpose of income tax law. Is it clear? Is it clear? Is it clear? 222E clause 1. It is suggesting that if a company is giving any loan or advance to their equity shareholders who hold 10% equity share in the company to the extent of accumulated profit of the company, that loan or advance is considered as dividend in hand, dividend for the purpose of income tax law. Number 2, if the company is not giving any loan or advance directly to that equity shareholder, but giving the loan or advance to any other concern in which that equity shareholder may have substantial interest during the previous year, and members of that another concern at the time when loan was given, in that situation also, that amount, the loan amount, should be treated as dividend to the extent of accumulated profit of the company. To satisfying this thing, applying this thing, first of all, you are supposed to check whether the loan is given to a concern in which the shareholders holding 10% or more equity share in our company have substantial interest in that company during at any point of time during the previous year. What do you mean by substantial interest? If that person have 20% or more equity rights in that concern, then that person is treated as substantial interest holder of that concern. Furthermore, the loan should be given to that concern in which that person should be member as on the date of the loan. He should have substantial interest during the previous year. Suppose in the 1st April 2022, he is holding substantial interest in X Limited, but loan was given on 1st July. Before 1st July, he sold entire stake, but 1%, that means 92% he sold out and 1% he retained with himself. In that situation also, if loan is given to that X Limited, then that loan or advance shall be treated as dividend to the extent of accumulated profit. Number 3rd one, if the payment has been made to any other person for the benefit of that type of shareholders who have 10% equity shares in the company, also treated as dividend for the purpose of income tax law. That dividend shall be taxable in hands of the recipient. There are few exceptions. And only one deduction is available from dividend. Only one expenditure is available as deduction from the dividend income, that is interest income. If the assessee, if the recipient, if the shareholder has invested money into the company and by taking borrowed capital, and against that borrowed capital, the assessee is paying interest. In that situation, dividend deduction is available on account of that interest expenditure to the extent of 20% of dividend income. Suppose if Mr. X invested rupees 10 lakh in company Y Limited by taking a loan at the rate of rupees say 12%. So for the year, the interest is 1,20,000, but during the year he got dividend of only 1 lakh. In that situation, he is eligible to claim deduction on account of this interest expenditure, but to the maximum of 20% of the dividend income. That is, instead of 1,20,000, he is eligible for deduction of rupees 20,000. 1 lakh was the dividend amount, 20% of that comes to 20,000. That means his taxable dividend income in this situation would be 80,000. 1 lakh as reduced by 20,000 comes to 80,000. That would be taxable income in hands of the shareholder. Any questions? Any questions? Shall I move to another topic? Gift. One of the important topics for your examination. Gift. In general, if someone is giving gift to you, it is not treated as your income. In general, someone is giving gift to you, it may not be considered as your income. But our income tax is thinking that there is something else. In the umbrella of gifts, there is something else you are receiving. That's why they are trying to tax that. This provision is applicable to all type of recipients. That may be you may be individual, the recipient may be individual, may be company, may be HUF or any other person. This provision relating to gift is divided into 5 categories. Number 1, gift of money. Number 2, gift of immovable property. Number 3, concessional receipt. Buying of immovable property at concessional value. Number 4, gift of movable assets. Number 5, purchase of movable assets at concessional value. All categories have separate provisions. We are supposed to understand each provision one by one. Category A, that means receipt in the nature of money. During the previous year, if the assessee has received any sum of money from one or more persons, that sum is without consideration. That's why this sum as a gift. If there is a consideration, you are receiving that money against certain consideration, then it is not treated as a gift. Here, you are supposed to receive certain money from one or more person, and that money is received without any consideration. The aggregate value of such receipt during the previous year exceeds 50,000. The aggregate amount of this type of receipt is rupees 50,000 or more than 50,000, then this provision is applicable. In this situation, the entire money received by you shall be taxable income under the head income from other sources. For example, Mr. X received 12,000 each from 5 of his friends on account of his birthday celebration. 12,000 from A, 12,000 from B, 12,000 from C, D, and E. The aggregate money received by Mr. X is 50,000, that is more than 50,000. that entire 60,000 shall be treated as income in hands of Mr. X, that is our asset. If the receipt amount, if the aggregate receipt amount does not exceed 50,000, then nothing shall be taxable. Suppose you received rupees 10,000 from four friends, A, B, C, D, 10,000 each. The entire receipt is only 40,000 since the amount received, aggregate value of the receipt during the year does not exceed 50,000, and nothing shall be taxable. However, if it exceeds 50,000, then entire value should be taxable. It is not like that 60,000 you received during the year, so 50,000 is the threshold limit, so only 10,000 would be taxable. No, this is not the like this. Entire 60,000 shall be taxable in your hand. Number 2, any immobile property. If you are getting immobile property without any consideration and the stamp duty value of such property exceeds 50,000 and you are taking that asset as a capital asset, in that situation, the value should be taxable in your hand. During the previous year, such person has received immobile property. Such immobile property is received without any consideration. You are not paying any money to the owner, and the stamp duty value of such property exceeds 50,000. Be careful here. The stamp duty value of such property exceeds 50,000 is mentioned. It is not mentioned that it's the aggregate stamp duty value. No. That means category B, we are supposed to examine the condition of 50,000 per incident basis. Unlike your gift of money, unlike your category A, where we are taking aggregate receipts during the previous year, here in category B, we are supposed to take 50,000 limit per incident. The stamp duty value of such property exceeds 50,000, and such asset is taken by you as a capital asset. In that situation, the stamp duty value of such property shall be considered as your income. The entire stamp duty value shall be considered as your income. For example, Mr. S received immobile property as a gift from Mr. Y, one of his friends. The stamp duty value of that is only 40,000. In that situation, nothing shall be taxable in hands of Mr. X. However, another friend, Mr. Z, provided a gift of immobile property to Mr. X. The stamp duty value of that property is 60,000. In that situation, since the amount exceeds 50,000, and entire 60,000 shall be taxable in hands of Mr. X under the head income from other sources. Here we are supposed to examine the limit of 50,000 per incident. Is it clear? Now comes to number C. If you are getting any immobile property at concessional value, for example, the value of the property is 1 crore, 1 lakh, and you are buying that against only 60,000 rupees. Here, since you are getting that asset, that immobile asset in concession value, in discounted value, you are supposed to examine the provision of gift, which suggests that during the previous year, such person has received immobile property. Such immobile property is received for a consideration, but that consideration is not as per stamp duty value. The stamp duty value of such property exceeds such consideration, and the difference between stamp duty value and your actual consideration is higher of these two things. 60,000 or 10% of consideration, whichever is higher. The difference between stamp duty value or actual consideration is higher of 50,000 or 10% of consideration. For example, you bought that asset for 60,000. The 10% of this is 6,000, 50,000, and the actual stamp duty value was only 1 lakh. In that situation, since the gap between stamp duty value and actual consideration does not exceed 50,000, and nothing shall be taxable. For example, stamp duty value is rupees 1 lakh. You bought this asset for 60,000. Now you are supposed to examine the gap between these two, that is only of 40,000. Now check this gap. Is it higher of this? 50,000 or 10% of 60,000, that comes to 6,000, whichever is higher. I believe 6,000 is higher value. Can I say that the gap between stamp duty value and actual consideration does not exceed 50,000 and nothing shall be treated as your income? However, on the other hand, if the value of stamp duty value is 2 lakh, in that situation, the gap is 1,40,000, which is more than higher of 50,000 or 10% of actual consideration, that is 50,000, and entire 1,40,000 shall be treated as your income. Yes, like another case B, like case B, here we are also examining this differences each incident. That means for each type of receipt of immobile property, you are supposed to examine this criteria. It is not the aggregate limit. You are supposed to examine for each and every incident. Any movable property. During the previous year, if you received any movable property from one or more persons as a capital asset, and such movable property is acquired by you without any consideration, the aggregate fair market value of such receipt exceeds 50,000, then the entire value would be taxable. Be careful here again. You are supposed to examine aggregate. In nutshell, in case of immobile property, whether it is free gift or it is a concession in value, you are supposed to take per incident limit. However, in case of gift of money or transaction relating to movable property, whether discounted or as a gift, you are supposed to consider aggregate value of all type of gifts per category. Similarly, if you are getting any immobile property and you are getting this property at below fair market value, the gap between fair market value and the actual consideration is 50,000. The aggregate gap is more than 50,000, then that gap would be considered as your income under the head income from other sources. This is a small chart. Taxation of gifts, section 56 to 10. It may be money, it may be movable property, it may be immobile property. In case of money, if you are getting tax bank or ECS, NEFT, RDBS, received from person or person in excess of rupees 50,000. That means aggregate limit is 50,000. If the total entire gift during the year exceeds 50,000, that whole amount should be taxable. In case of movable property, if you are getting that movable property without consideration and the aggregate fair market value of this type of property exceeds 50,000, then entire fair market value is taxable. Whereas if this movable property is received by you, acquired by you for inadequate consideration, in that situation, if that fair market value is greater than your consideration by rupees 50,000, then the difference shall be taxable. In case of immobile property, here for incidents you are supposed to examine. Without consideration, if stamp duty value exceeds 50,000, then whole entire stamp duty value shall be taxable. Be careful here for incidents is applicable. Inadequate consideration. If you are buying any immobile property without paying adequate consideration, that inadequate consideration, that means you are paying below stamp duty value. That situation, if the gap between stamp duty value is higher of 10% of consideration of rupees 50,000, in that situation, difference shall be taxable under the head income from other sources in the hands of the assessee. Is it clear? Is it clear? Is it clear? Any question till now? Any question till now? There are a couple of examples. You are supposed to examine whether the provision is applicable or not. Mr. Anand received cash gift of rupees 1 lakh from his friend Mr. Lucky as on 10/10/2022. Since the cash gift is of rupees 1 lakh, this exceeds rupees 50,000 and the entire 1 lakh shall be taxable in hands of Mr. Anand. Another situation, as on 12th November 2022, Mr. Ajay received cash gift of rupees 25,000 each from his three friends. One of them is a non-resident. It hardly matters to us. The aggregate receipt is 75,000. The aggregate amount of receipt is 75,000, which is more than 50,000, and entire 75,000 shall be taxable. It is, even though each receipt does not exceed 50,000, we are not supposed to examine each receipt. We are supposed to examine the aggregate amount, and then we are supposed to check whether the aggregate amount exceeds 50,000. If yes, then intra-value shall be taxable, as nothing shall be taxable. Similarly, gift of immobile property. As on 10th January 2023, Mr. Party received a piece of land. Stamp duty value is rupees 75,000 from his friend Mr. Raja without any consideration. Such land was acquired by Raja in 2001-2 for rupees 10,000. Since the amount, the stamp duty value of this land is 75,000, the stamp duty value of this land is rupees 75,000, which is more than 50,000, and this 75,000 shall be considered as income of this party for the assessment year 23-24. Is it clear? If this is the case, in future, say Mr. Party sold this land to another person, what would be considered cost? If the provision of gift is applicable at the time of acquisition of this land, then the value which we considered for the purpose of this provision should be considered as the cost in hands of Mr. Party. Number next, on 10th December 2022, Deepak received a piece of land at Napasar from his friend Vikas. Stamp duty value is 46,000 as a gift. Such land was acquired by Mr. Vikas in 2001 for rupees 5,000. Further, as on 1st November 2022, Deepak also received one land at Bikaner. Stamp duty value is 30,000 without any consideration from Anil. Do you think any provision relating to gift is applicable in hands of Mr. Deepak? In this incident, Deepak got two pieces of land from two different friends, and incidentally, the stamp duty value of each piece of land does not exceed 50,000, and nothing shall be taxable in hands of Deepak under the provision of Section 56(2)(10). In spite of the fact that aggregate value of the gift exceeds 50,000, we are not supposed to check aggregate amount in case of gift of immobile property. We are supposed to examine per incident. Here, the stamp duty value of the land provided by Mr. Vikas is only 46,000, and this is not taxable in hands of Mr. Deepak. And the stamp duty value of the land provided by Mr. Anil is only 30,000, which is again does not exceed 50,000, and nothing shall be taxable in hands of Deepak on account of this receipt. Since the receipt that this land is not considered as a gift for under the Section 256(10), and the cost of acquisition in hands of Deepak for this land would be considered as 5,000 or 10,000 respectively. That is, the cost of previous owner should be considered as the cost of acquisition in hands of Mr. Deepak. In near future, if Mr. Deepak sold this asset, then the cost of acquisition would be 5,000 or 10,000 respectively. One more thing, what would be the tax consequences in hands of Deepak, in hands of Mr. Vikas and Mr. Anil? Anyone? What would be in hands of Deepak? This is not taxable. Then what happened in hands of Mr. Vikas or Mr. Deepak? Someone is asking meaning of limit per incident. That means per transaction, 50,000 per transaction. In case of immobile property, in case of provision relating to immobile property, you are supposed to examine the limit per transaction, not the aggregate limit for entire transaction during the year. In case of cash gift, we are supposed to get aggregate amount of the cash gift received during the year. In case of movable assets, we are supposed to find out aggregate fair market value of entire year. But in case of immovable property, we are supposed to examine the stamp duty value per transaction. Suppose one got, like in this our example, Mr. Deepak received 2 pieces of land, even though the aggregate stamp duty value exceeds 50,000, but we are supposed to examine 50,000 limit per transaction. In first transaction, the stamp duty value is only 46,000, and in another transaction, it is only 30,000, even though aggregate value exceeds 50,000. But since the matter is relating, the fact is that what he is getting immovable property. In case of immovable property, the limit is supposed to be examined per transaction. Per transaction, the 50,000 limit is applicable. So nothing shall be taxable in hands of Mr. Deepak in this situation. What happened to Mr. Vikas or Mr. Anil? Any idea? Anyone? Capital gain arise in hands of Mr. Anil or Mr. Vikas? What is your take? Does Mr. Vikas liable for any capital gain for this transaction? No. Why no? The reason is gift. This is the gift, and gift is not treated as a transfer. And hence, the question of capital gain does not arise in hands of Mr. Vikas and Mr. Anil. Yes. Now, acquisition of immovable property at concessional amount. As on 10th January 2023, Mr. Tipu purchased a piece of land. Stamp duty value is rupees 75,000 from his friend Mr. Uday against consideration of rupees 30,000. Mr. Uday has acquired such land for rupees 25,000 in financial year 2006-7. Tipu sold such land for rupees 1,75,000. Stamp duty value of such is rupees 1,60,000. First of all, examine whether the provision of 56(2)(10) is applicable in on Mr. Tipu for getting this piece of land. The stamp duty value is 75,000 and the actual consideration is 30,000. The gap between the stamp duty value and the actual consideration you are supposed to examine. The gap is only of 75 minus 30. Can I say the gap is only 45,000? That gap does not exceed 50,000, and nothing shall be taxable in hands of Mr. Tipu under section 56(2) tax. Is it clear? Since nothing is taxable under section 56(2) tax, in that situation, the cost of acquisition of this land in hands of Mr. Tipu is considered as 30,000. That is the cost of the previous owner for the purpose of computing capital gain in future. Yeah. Now, this one. As on 10th Feb 2023, Mundra Services Private Limited purchased a piece of land. Stamp duty value is rupees 7,50,000 from one of the friend Mita of the director against consideration of rupees 3,90,000. Mita has acquired such land for rupees 25,000 in 2000. On 10th April 2024, the company has sold such land for rupees 10,75,000. The stamp duty value is rupees 12,50,000. Now, first of all, examine the provision of section 56(2)(10) in hands of Mundra Services Private Limited. Is it the provision of 56(2)(10) is applicable in case of company, or it is not applicable? Yes, sir, it is applicable in case of all type of person. It may be individual, it may be company, HF, whatever the category of the person. The provision of section 56(2)(10) is applicable. Now, the Mundra Service Private Limited has purchased the land. The stamp duty value was 7,50,000. But the actual translation was only 3,90,000. The gap between the stamp duty value and actual consideration is 3,60,000. Now examine whether this gap is more than higher of 10% of your actual consideration or rupees 50,000. Yes, sir. It is more than 50,000. Hence, the provision relating to 56(2)(10) is applicable in case of Mundra Services Private Limited. 3,60,000 shall be considered as income from other sources in hands of the company. But since the provision of gift is applicable in case of Mundra Services Private Limited, the cost of acquisition for this land would be 7,60,000 in hands of the company. Here, be careful, the cost of previous owner is not applicable. Why not applicable? He is not getting that land as a gift. The Mundra Services Private Limited is acquiring this asset. This is not the case of gift, and we are not supposed to consider the cost price of Mita for the considered as the cost of acquisition in hands of Mundra Services Private Limited. Is it clear? Now comes to this one. On 10th October 2022, Sonam purchased a piece of land from her friend Sweta. Stamp duty value was rupees 12,64,000 or rupees 12 lakh. Now examine whether the provision is applicable or not in hands of Ms. Sonam. The stamp duty value is more than actual consideration. Actual consideration was only 12 lakhs, whereas stamp duty value was 12,54,000. Can I say that stamp duty value is more than actual consideration? In that situation, we are supposed to find out the gap. The gap is 54,000. The gap between stamp duty value and actual consideration is 54,000. Now examine. Is it 50,000 or 10% of actual consideration? Is it higher of 50,000 or 1,20,000? The gap is only of 54,000. The gap does not exceed 1,20,000, and the provision of section 56(2)(10) is not applicable in hands of Ms. Sonam. Is it clear? Is it clear? Number next, on 10th October 2022, Dia purchased a piece of land from her friend Monica. Stamp duty value was 4,45,000 for rupees 4 lakh. You are required to examine whether the provision of section 56(2)(10) is applicable in this transaction or not. Try to check. First of all, this transaction is relating to immobile property. The stamp duty value exceeds actual consideration. The gap between stamp duty value and actual consideration does not exceed 50,000 or 10% of actual consideration, whichever is higher. 50,000 or 40,000, whichever is higher. 50,000 is higher. So the gap is only of 45,000. Nothing shall be taxable in hands of Priya under the head income of other sources. As on 10th January 2023, Narendra received gold necklace. Fair value is rupees 1,85,000 from Vivek without any consideration. Is it transaction relating to movable or immobile property? The transaction is relating to movable property. We are supposed to examine the limit 50,000. Aggregate limit of rupees 50,000. Here only one gift is there. The fair market value was 185. The consideration was 0. Thus, entire 1,85,000 shall be taxable in hands of Narendra for under the head income of other sources. On 10th October 2022, Mohan received share from his friend Uttam. Fair value was rupees 36,000 and not acquired through Uttam as a gift. Further, as on 1st November 2022, he also received gold chain. Fair value rupees 30,000 without any consideration from another friend. In first case, he is getting shares of rupees 36,000. In another case, he is getting some gold chain for rupees 30,000. Altogether, the movable property he is getting is 66,000. you are supposed to examine the aggregate in case of movable property. Aggregate amount exceeds 50,000 and entire 66,000. That is 36,000 on account of shares and 30,000 on account of gold chain would be taxable in the hands of Mr. Mohan. Number next, on 10th October 2022, Janak purchased jewelry from his friend Giri. Fair value was 66,000 for rupees 30,000. Further, as on 1st November 2022, he also purchased silver utensils from another friend rupees 75,000. The gap is 36 plus 25. The gap is 36 plus 25, that is 61,000. And the aggregate gap between this exceeds 50,000 and entire 61,000 would be taxable under the head income of other sources. Certain exceptions are there. Is it clear to all the provision relating to gift? Provision is clear to all? There are certain exceptions. There are certain exceptions. In case such gift is received from this type of person or in this different scenario or this situation, then nothing shall be taxable under the head income from other sources on account of this type of transaction. What are those scenarios and those persons? If someone is getting gift from their relative, then nothing shall be taxable. What do you mean by relative? Here, in case of an individual, relative means spouse, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, any linear ascendant or descendant of the individual, any linear ascendant or descendant of the spouse of the individual, and whoever is mentioned here, the spouse of all type of this person. For example, for an individual, the relative may be father, mother, spouse, son and daughter, brother and sister. Further, his father's brothers and sisters, that means uncle and aunt. In Hindi, we may term this like chacha and bhuva. From maternal side, mama and masi, brother of his mother and sister of his mother. Spouse, brother and sister, in Hindi, we may term as a sala and sali. And father-in-law and mother-in-law, that means saas and satur. And wherever we are using, say, for example, uncle be covered, then auntie is also covered. If we say that mama is covered, then mommy is also covered. If we say bhua is covered, then husband of bhua is also covered. Is it clear? Number two, if you are getting the gift on occasion of the marriage of the individual, whether gift is received from relative or outsider, nothing shall be taxable. To avoid this provision, you are supposed to remarry again and again. If at the time on the occasion of the marriage, if you are getting some gift, whether from your relative or from outsider, whatever the quantum of the gift, nothing shall be taxable under the head. Suppose Mr. X is going to be married on 10th July 2022. On this date, he got several gifts from various persons amounting to rupees 5 lakh. His brother is also getting some gifts due to the marriage of Mr. X. Someone are also giving a gift to the brother of Mr. X, and that was rupees 1 lakh. That situation, what will happen to the gift money received by brother of Mr. X? In case of Mr. X, entire 5 lakhs will be not taxable. However, in case of brother of Mr. Y, the aggregate amount of gift exceeds 50,000 and entire 1 lakh will be taxable in hands of Mr. Brother of Mr. provision, on the occasion of the marriage, the exception, on the occasion of the marriage of the individual, शादी हो रही है उसी को मिलता है, then it is exempt, then it is exempt. Another person is getting also some gift during the marriage party, then that would not be treated as an exception. Number 3, if you are getting something under a will or by way of inheritance, then nothing shall be applicable. Number 4, in contemplation of death of the payee or donor, if you are getting some money from local authority or someone getting some money for the treatment of COVID-19, and if someone is getting a member of the family of a diseased person is getting some money from the employer of the diseased person, then that without any limit, whatever is the limit, it shall not be taxable under the income from other sources. Furthermore, if that family is getting money from any other person, then up to 10 lakh of the gift, up to the 10 lakh of the money is not treated as income and for the family of that diseased person. The COVID situation is about provision. If you are subject to certain rules and regulations, you are supposed to go with that rules and regulations. Apart from that, please note that here, what is supposed to be the matter of the gift, property, including virtual digital assets in cryptocurrency like that, is the following capital assets of the company, of the asset. Immobile property, shares and securities, archaeological collections, paintings, jewelry, drawings, sculptures, any work of art, and bullion. If you are giving certain quotes to your friend worth rupees 1 lakh, nothing. This provision is not applicable at all. This provision is applicable only if the property, the assets which are subject matter of gift are relating are these assets. If you are giving these assets as a gift, apart from money is also there. Immobile property, shares and securities, archaeological collections, paintings, jewelry, drawings, sculptures, any work of art, and bullion, including virtual digital assets. Only these properties are covered under the provision of Section 67. If you are giving money, yes, the provision is applicable. If you are giving cloth, the provision is not applicable because cloth is not treated as a property for the provision of this section. What are considered as a property for the provision of this section? Virtual digital assets, immobile property, shares and securities, archaeological collections, paintings, jewelry, drawings, sculpture, any work of art. Here, if one of your friends gives you a gift of a motor car, are you covered under Section 62? No, motor car is not considered as a property for the purpose of Section 62. Be careful. Money plus this 1, 2, 3, 4, 5, 6, 7, 8, 9. These 9 items are considered for the purpose of Section 66. Is it clear to all? Is it clear to all? Is it clear to all? Any question? Anyone have any question, any query? Anyone? Anyone have any question? Okay. Now, few more assets, few more provisions some are taxable under the head income from other sources. We are covering stuff. You know family pension. Number 1, casual income. Casual income like winning from lotteries, corporate puzzles, etc. will be taxable under the head income from other sources, and that income will be taxable at the rate of 30%, max 30% plus surcharge plus without taking the benefit of unexhausted exemption limit. This is taxable at the rate of 30% plus surcharge. In general, be careful. Sometimes it may be mentioned in your question, lottery income received. Try to understand the relationship between lottery income and lottery income received. There is a TDS. That means on the lottery income, if it's 10,000, then TDS at the rate of 30% is applicable. That means there is a gap between the amount received and the income, actual income from lottery. If you are receiving 70,000 as a lottery income, that surely your income would be 1 lakh. How could I derive this 1 lakh? 70,000 is the 70% of your entire income. And your income would be 1 lakh. 1 lakh would be taxable in your hand, not 70,000. Be careful on this. Income from machinery, plant, or furniture let on hire, whatever income you are getting, if these are not considered as your PGB income, then surely it would be taxable under the head income from other sources. Income from machinery, plant, or furniture let on hire along with building. This is the case of composite rent. Generally, if building or these machineries are separately given on rent, then the rent received on building would be taxable under the head income from house property, and for this machinery, plant, or furniture would be taxable under the head PGB or income from other sources. However, if this is a composite rent, that means this let out is not separable, it is inseparable. In that case, the entire rent would be considered under the head PGB or under the head income from other sources. If you are not owned by PGB, surely it will be taxable under the head income from other sources. The question of income from property does not arise in this type of family pension. If someone is getting family pension from the employer of these employees, that situation, that family pension would be taxable under the head income from other sources. Why it would be taxable under the head income from other sources? Why it is not taxable under the head salary? Because the relationship between the recipient and the employer, the payer, are not of employer-employee. The relationship of employer-employee was of the employee with their payer. Here, the pension is paid to the family member of the deceased, and the relationship of employer-employee does not exist. The question of salary does not arise. In that situation, the recipient will get reduction, standard reduction of rupees 1/3 of that pension or rupees 15,000, whichever is lower. Suppose someone is getting family pension from the employer of the deceased husband worth rupees 1 lakh, then 1/3 of 1 lakh or rupees 15,000, that is 15,000, would be standard deduction, and the remaining amount after this standard deduction, that is 65,000, shall be taxable under the head income from other sources of receipt. There is one example. Sundar died on 31st July 2022 while being in the central government service. In terms of rules governing his services, widow Mr. Sundar is paid a family pension of rupees 10,000 per month and D of rupees 40% thereof. State whether the amount of family pension is applicable in her hand, and if so, under what head of income. Here he is getting 10,000 per month and 4,000 as a DA. Can I say that altogether 14,000 per month he is getting since August 2022 to March 2023? Can I say it is each month for 14,000? Entire receipt as a family pension is 1,12,000. Out of this 1,12,000, he is eligible for standard deduction amounting to rupees 15,000. How do I calculate this 15,000? 1/3 of 1,12,000 or rupees 15,000, whichever is lower. The lower portion is 15,000. The remaining amount, after reducing standard deduction of 15,000, it got 97,000. That amount, this 97,000, would be taxable in hands of Mrs. Sundar under the head income of other sources. We already done. Few more provisions are there related to income from other sources. We are supposed to understand. Share premium in excess of fair market value. Sometimes what happened in 2012-13, what happened? The company is issued shares at premium. Face value of the share would be 10 rupees and premium amount is 90 rupees, 490 rupees, 990 rupees. Whatever amount they can charge, they are issuing the amount at that premium. So the government thought that there is something we are supposed to control over this type of issue. So brought this provision into the income tax law. If your premium exceeds fair market value, their premium amount exceeds fair market value, then the gap would be taxable under the head income from other sources in hands of that company. For a company, not being a company in which the public are substantial interest, again, this provision is applicable only in case of closely held company, that means private company. Received in any previous year from any person, being a resident, that means allotee should be a resident person. From 24-25, A by 24-25, it is resident as well as non-resident, but still your examination, it would be big writer receipt. That means the allotee should be a resident person. The investor should be a resident person. Any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such share as exceeds fair market value. For example, there are one illustration for illustration here. Share issued by Free Private Limited. Issued to Mr. A, we are presuming this person is a resident. Face value is 10 and fair market value is 12. And consideration, that means they are issuing these shares at rupees 11. Can I say that your consideration does not exceed fair market value? Fine. Yes, does not exceed fair market value. This provision is not applicable. In another situation, Two Private Limited, share issued to Mr. B, face value was rupees 10, fair market value was 12, consideration was rupees 9. Here also, the consideration does not exceed fair market value as well as face value. In case share is allotted at discount value, this provision is not applicable. R Private Limited, Mr. C, face value was 10, fair market value was 5, consideration was 10. In this case, even though consideration is more than fair market value, but the share is not issued at premium, it is issued at par. The face value was 10, the share is also issued at par, and the share is not issued at premium. The provision of section 56(2)(7)(b) is not applicable. Next, S Private Limited, share issued to Mr. C, face value was 10, fair market value was 15, and the consideration is 20. Here the shares are issued at premium, and that consideration is more than fair market value. The gap between fair market value and the actual consideration would be treated as income from other sources in hands of the company. Here the company is as private limited. Rupees 5 per share shall be considered. What is the 5? 20 minus 15. That is rupees 5 per share shall be considered as income in hands of recipient company. E Private Limited, and recipient is a non-resident. In case of non-resident investors, the provision is not applicable at all. Be careful, from assessment year 24-25, this provision is modified. But till your examination in December 2023, in case if the investor, if the shareholder is a non-resident, and this provision is not applicable at all. U Private Limited, Mr. S, a non-resident at the time of issue of shares. However, later on, during the previous year, he became resident. Earlier, he was non-resident, but now, during the same previous year, he became resident. This situation, the share face value was 10, fair market value was 20, and the actual consideration would be 35. The gap between 35 and 20, that is 15, shall be considered as income of U Private Limited. Number next, V Private Limited. During the previous year, such company has listed itself in the NSE after issuance of such shares. Since this is not a closely held company, now it's become a widely held company. The provision of section 56(2)(b) So 7B is not applicable on this type of company, and nothing shall be taxable under section 7B. Income by way of interest received or compensation or an enhanced compensation. Suppose government acquired certain immovable property on compulsory basis, compulsory acquisition was there, and there is some delay in giving some compensation or enhanced compensation to the assessor. Due to this delay, government is paying certain interest to you. In that situation, that interest will be considered as your income. Surely that interest income is considered as your income. That interest is your income. That interest income ideally should be taxable in the year in which it may accrue or it may be received, depending on the method of accounting followed by you. But to clear the cloud, government is saying that this interest would not taxable on the basis of your method of accounting or on the basis of mercantile basis. It would be taxable in the year in which you receive this money. Forget for which period this interest burden, this amount would be the interest component would be taxable in the year in which you receive this money. Further, one more thing, you will get a standard deduction out of the interest income that would be 50%, 50% of that income. Suppose during the year, Mr. X received 65,000. Out of this 65,000, 45,000 pertaining to the previous year 21-22 and remaining is for 22-23 as interest on delayed compensation. Such interest, after allowing a standard deduction, 65,000, 50% would be available as standard deduction. That comes to 32,500. This 32,500 shall be taxable in the year of 16. Even though this interest, certain portion of this interest may be pertaining to some other previous year, we are not supposed to consider this accrual basis. We are supposed to taxable this interest income on receipt basis, irrespective of whatever method of accounting you are following. This 32,500 shall be taxable in the year of receipt, that is previous year 22-23. Can I say that it will be taxable in subsequent year 23-24? Employees' contribution towards staff welfare fund or scheme. Any question till now? Any question till now? Any question till now? Anyone have any query, any question till now? Shall I continue? Okay. Employees' contribution towards staff welfare fund or scheme. Ideally, this section is parallel to section 36(1)(5)(a), which is covered under the head P. Whenever you deduct money from your employee for contribution as a contribution towards certain welfare scheme, that would be considered as your income. And once you make the payment within the cutoff time, within the due date, in that situation, equivalent deduction is available to you. In short, whenever you deduct the money from your employee as a contribution to certain staff welfare fund, it will be treated as your income. And when the money, that contribution is deposited into the respective welfare fund within the due date of the respective act, then you will get equivalent deduction. First plus, then again minus, the net effect will be laddu, net effect will be nil. However, if you fail to deposit that money, within due date in the respective provident fund or welfare fund, that situation, you will not get any deduction. That means income was there at the time of deduction, that deduction will be considered as your income, but you will not get deduction since you did not pay to the respective welfare fund. Even though you did not, you paid the fund, you paid the contribution to the respective fund, but that is after due date. In that situation, you will not get the deduction. That means positive income will happen, but deduction was not there. The net result that deduction would be considered as your income if you are following your PA. If you are doing business, then it would be taxable under the utility. If you are not doing business, then it would be taxable under the income from other source. Interest on securities. Interest on securities, if you are held as a stock in trade, if these securities are held as a stock in trade, then whatever interest you are earning would be taxable under the head PBT. For others, it would be taxable under the head income from other sources. When it would be taxable, depending on method of accounting followed by you, it would be taxable. Depends and bypassing this part. Now we have a couple of illustrations for you. Certain toxic disallowance or are generally we already usually got the provision under the head PG. Following expenditures shall not be deducted from any income under this head. Personal expenses, any interest which is payable outside India without deducting CPS, any salary payable outside India without deducting CPS, and 30% of any payment made to a resident on which CPS is required to be deducted. Any amount paid as a wealth tax or income tax is not available as a deduction. Any amount is specified under Section 40A, like payment of to relative in excess of requirement. This provision is directly linked with the PG income. Payment in excess of 10,000, otherwise than an account by check, etc. Again, these are related to GDP, and nothing is available as deduction from lottery, stock, or further etc. Yeah? Now we have some illustration for you. First of all, try to solve this one. You have time of 5 minutes to solve this one. After that, we will do an try to solve this one. You have 5 minutes time to solve this one. You got the solution? Please try to solve it. You have 5 minutes time. Anyone got the answer? Please post here. Shall we solve simultaneously together? Okay. Compute taxable income under the head income from other sources of Mrs. X from the following data. Private tuition fees is fees. If it is not taxable under other heads of income, surely it will be taxable under the head income from other sources. Winning from lottery, 2,000. Since the amount does not exceed 10,000, we can say that there was no TDS on it, so inside 2,000 would be taxable. Dropping up is not required. Award from KBC, a TV show, again it would be taxable under the head income from other sources as casual income. Pension from employer of deceased husband, yes, that is also considered as income from other sources. However, the assessee is eligible for standard deduction. Standard deduction would be 1/3 of the pension amount or rupees 15,000, whichever is lower. So the standard deduction would be 8,333. We reduce that one and got 16,667 as a taxable income. Interest on bank deposits shall be taxable under the income from other sources. Director fee, it would be taxable again under the head income from other sources. Letting out of vacant land, it may be taxable under the head income from house property. What is your idea? What is your suggestion? Sir, though it is from immobile property, but it is not considered as a property for the purpose of income from house property. For the purpose of income from house property consists of building and land appertaining thereto. Since this is a vacant land, no super construction, so the entire 25,000 shall be taxable under the head income from other sources. Remuneration for taking the examination copy of employer is full. Since employer-employee relationship is there, you may say that this would be taxable under the head salary and it is not taxable under the head income from other sources. Remuneration for checking the examination copy of CA, surely relationship of husband, employer and employee does not exist. This 10,000 shall be taxable under the head income from other sources. Income tax refund. Is it income? What is your idea? Income tax refund. Is it income? Income tax refund is not considered as your income because it is the income or belongs to you, which is paid to the government. Now the government is giving back. This is not a separate income. Interest on income tax refund, surely it would be considered as your income, and this 100 rupees shall be taxable under the head income from other sources. Composite rent shall be taxable under the other sources and after reducing related expenditure of rupees 5. Rent on subletting of house property. Rent paid to the original owner 12,000 and you are getting 20,000. So net your income would be only 8,000, 20,000 as reached by 12,000 shall be considered your income and 8,000 will be taxable under the head income of other sources. Income tax paid is not a deduction, is not a available eligible deduction, so nothing to be done. Payment made for personal expenses, this is not a valid expenditure. Payment made to LIC as a premium, again this is nothing to be done with your earning income. So your income from other sources in this case comes to rupees 4,26,767. Is it clear to all? Is it clear? Now we have one more question. Try to solve this one. Try to solve this one. This question have some part on. Now I think it is on one page. Now try to solve this one. You have 5 minutes time for this. Try to solve it. Right now it is 26, 21 till 26 you have time. After that you will do some more illustration from different chapters. Huh? Okay, we are solving this parallelly. Sri Anil follows that process of accounting and has furnished the receipt and payment account of previous year 22-23 for company. Be careful unless until something is specifically mentioned, income from other sources and PBT income shall be calculated depending on your method of accounting, followed by you. Then here Mr. Anil is following cash basis, his income would be computed following cash basis, considering cash basis. Interest on debenture of pay limited 15,000, letting of building and machinery at the rate of rupees 15,000 per month under a composite lease of rupees 1,50,000. Collection charges 1,000 is paid, repairs 5,000 is paid, capital repair is paid, interest paid outside India without deducting TDS 6,000. This is not available as a deduction. Capital expenditure is not available as a deduction. Gift from father. Father is considered as a relative and this is not taxable. Ground rate received relating to financial year 21-22. Even though it is relating to financial year 21-22, the income will be this 600 would be taxable on cash basis. The following additional information are also provided. Probable depreciation on building and machinery will be considered this one. Fire insurance on this building and machinery was not paid. Since we are following cash basis, this would not be considered at all. So the income would be from debenture 18,000, interest received on letting of assets 1,50,000, collection charges we will reduce this one because it is paid. Repairs 5,000 we will consider. Capital repair we already discussed. Capital expenditure should not be allowed unless and until it was specifically mentioned. Interest since it is paid outside India, nothing shall be allowed without India. And depreciation is given rupees 4,000 we will consider. Gift from father is not considered income. Ground rent received, it is on receipt basis, it will be taxable. Altogether his income would be 1,50,000. Now I am shifting to some illustration we are supposed to consider. Yes, sir. Mr. Bharat, an engineer. This may be from some other chapter, but surely it's from your syllabus. Mr. Bharat, an engineering graduate, born and brought up in India, got employment in USA in August 2022. By what date he should leave India in order to become a non-resident? Now, what is his, he got a job in USA in August 22. His employer is saying that you may visit to USA at any time within the next 3 months. Now, Mr. Bharat wants to non-resident status, but he also simultaneously wants maximum number of days he would like to reside in India. So, suggest him the date on which he should left so that residential status will be of non-resident. Please calculate that. Please calculate the date on which he should left India so that his status would be non-resident and maximum number of days he should leave India with non-resident. Anyone? You have 2 minutes time. Please try to solve it. Ideally, an person is considered as a resident in India only if he decides to stay in India for 180 days or more, or 60 days or 65 days in 14 days. Yeah, we all know about this. However, in certain scenarios, this provision as this 60 plus 365 criteria is not applicable. Number one, if an Indian citizen living in India for employment purpose during the previous year, 60 plus 365 criteria is not applicable. Here, Mr. Bharat is the Indian citizen living in India for employment purpose and 60 plus 365 criteria is not applicable. Become a resident in this type of case, we should satisfy Section 618, that is 180 days or more. We should stay in India for 180 days or more during the previous year. So, what can I suggest? On 181 days of the previous year, we should leave India for on 181 days, that you are supposed to calculate that date, April 30 days, May 31, and accordingly you are supposed to calculate first 181st day of that year, of that financial year, you should leave India to become a non-resident. So ideally, you should leave India before 29th September 2022. That means they take flight by 20th September 2020. Okay. Now, one more illustration I have. You are supposed to solve this one. Six. Illustration number 6. Round. A citizen of Bahama came to India for the first time on 10th August 2017. They say up to 5th March of 2018. Subsequently, he stayed in India during the 18, 19, 19, 20, 20, 21, 21, 22, and 23. There is number of days are given. Determined his residential status for the AY 23-24. During the previous year, 22-23, he earned income of rupees 2,50,000 from business in Bahama, which is controlled from India. Discuss the taxability of such income in India. Be careful. Nowadays, if you go through the pattern of the question, if you analyze the question paper on more and more on analytical basis, that means more and more on application basis. So they will not trying to ask direct questions. They are trying to give a question where you are supposed to apply your theoretical knowledge and try to find out the actual apply that theoretical knowledge to trace the problem or to evaluate the situation. In this order, try to find out the taxability of this 2,50,000 from a business in Bahama, which is controlled from India. Theoretically, we all know that this 2,50,000 should be taxable in India only in case if the FSC is the ordinary resident, and number 2, if the resident but not ordinary resident. In case of non-resident, this would be not taxable at all. Now, we are supposed to find out his residential status, and depending on that residential status, we are supposed to comment on this income, on taxability of this income. So, first of all, we are supposed to find out the residential status of Mr. Cloud. During the previous year, he was in India for one moving all this picture. During the previous year, 20 to 23, he was in India for 62 days, and in last 4 years, 85 plus 100 plus 120 plus 110, he was in India for 450 days. Can I say that he satisfies section 1C? Since he is a citizen of Bahama, no exception is applicable. So he is satisfying section 61A, and he became a resident. Once you term him as a resident, you will be asked whether he is the ordinary resident or not. What is the difference? If a resident is satisfying conditions given under section 6, he will be considered as the ordinary resident, else he will be considered as not ordinary resident. Now we are finding out what type of resident he is. First time he came India on August 27 and left India for 2018, and thereafter we already know number of days: 55, 100, 110, 120. And during the previous year, 2017-18, he came on 10th August and left India on 5th March 2018. So altogether, he was in India for 208 days for that particular financial year. So in last 7 years, he was in India. He was in India for he was in India for 730 days or more. No, he was in India only for 624 days. Only for 624 days. Which did not satisfy both conditions given under section 6. What should be his residential status? That his residential status would be a resident but not ordinary resident. Now come to that income part. That income would be taxable in India because the income, the business is controlled from India. In case of a not ordinary resident, any income outside India, if that income is from a business which is controlled from India, is liable to be taxed in India. And this 250,000 will be taxable in India. So, just try to solve this one. We have 5 minutes time. Try to solve this one. Mr. Pankar Roy, an Indian citizen, left India for the purpose of employment in USA for the first time on 1st October 2022. Came back to India on 30th March 2023 for visit and returned back to USA after 20 days in India. During the previous year 22-23, he earned the following income. Salary earned in USA rupees 5 lakh and credited in USA. Interest received in India out of which deposit in bank 1,20,000. So first of all, we are supposed to check his resident status. Since he left, he is living in India first time on 1st October 2022. We are supposed to examine the number of days he stayed in India during the financial year during the previous year 2023. I believe during the previous year 2023, he was in India for 160 days, which is started from April to March in this way. Since he was in India for 182 days or more, he is a resident. And since he is living in India for first time, he is also satisfying section 66. And he is a resident and ordinary resident. If he is an ordinary resident in India, then whatever income he is earning, even though it is from another country, it would be taxable. And accordingly, this 5 lakh and this 1,20,000, I believe this 5 lakh is a net of standard return, would be considered as an income liable to be taxed. Here, more thing. I'll try to solve this one. In 2 minutes time you have, please try to solve it. Payment time you have. Try to solve this one. Session will be our last class for direct taxation. Remaining 2 classes will be indirect taxation. Manufacturing sector. Data for the previous year 22-23 are as follows. Cost of cultivation of sugarcane 5,000 tons is 10 lakhs. Sugarcane sold in market 1,000 tons at 3 lakh rupees. Sugarcane used for sugar manufacturing, the remaining sugarcane would be sugar manufacturing. The cost would be zero, obviously. Cost of conversion would be 5 lakhs. The salary to staff is 2 lakhs. And sugar produced and sold in market for rupees 25 lakhs. Some to income of excess. Here, the question arises, part of the income would be your agricultural income and part of the income would be non-agricultural income. Since in case of tea business, if you are a grower and manufacturer of tea in India, there is certain percentage are there, 60 or 40. Some in case of rubber, in case of coffee, there is certain percentage was prescribed. But for this type of business, there was no certain percentage was prescribed. You are supposed to prepare 2 different sets of beer. One is for computing and another is for completing the agriculture. Sale of agro product in market, manufacturing, since entire 3 lakh would be considered as your agricultural sale. Sale of manufactured product in market, this is sugar, that is 25 lakh. Notional sale of agro product used in the process of manufacturing. What we consider, this 4,000 tons was used by the factory. This should be considered as a sale. This would be considered a sale to the factory at the price fair market value. The fair market value 1,000 tons is rupees 3 lakh. And what should be the fair market value of this 4,000 tons? And we will consider this 1 lakh as a revenue for the agricultural business. Altogether, revenue for the agricultural business amounting to rupees 15 lakh. Now, this 12 lakh we will consider as a cost, as a raw material cost for the manufacturing site. So, my profit from manufacturing business would be sale 25 lakh, cost of conversion 5 lakh, value of raw material 12 lakh, salary to staff 6 lakh, we got 23 as a cost, and remaining amount, that is 2 lakh, should be considered as my income from manufacturing business, and 5 lakh is considered as my business, my income, agricultural income. Is it clear? We have some more. Now try to solve this. Yes, by part. Mr. Bhaumik of Siliguri is offered an employment by Vimal and Company Limited, Kolkata, on a basic salary of rupees 5,500 per month. Other allowances are DNS allowance not forming part of salary for retirement benefits, is 4,000 per month. Medical allowance is 1,000 and bonus is 1 month basic salary. The company gives an option to Mr. Bhaumik either to take a rent-free accommodation in Kolkata of the fair rental value of rupees 1,000 per month, or to accept a cash house rent allowance of rupees 1,000 per month. Mr. Bhaumik decides to accept cash house rent allowance and take a house in Kolkata at a monthly rent of 1. Please suggest Mr. Bhaumik whether he made a wise choice or he can do otherwise. What is your suggestion to Mr. Bhaumik? You have 3 minutes time to calculate, to evaluate the decision made by Mr. Bhaumik, whether he is on right track or whether he is on he should do other options. Please, you have 3 minutes time to solve this one. You are supposed to examine the decision made by Mr. In this type of case, you are supposed to prepare 2 different sets of income. One considering the rent-free accommodation and another considering house rent allowance. What should be his income in either situation? And where the income is reduced, taxable income is on lower side, that should be considered as correct option. Now, if we consider the another option, basic salary 5,500 per month, it comes to 66,000. Both the options, it would be common. Other allowance are DNS allowance 4,000. It will be taxable in either situation 48,000. Medical allowance would be taxable in either of the situations, and bonus being 1 month basic salary would be taxable in either of the situations. The difference is that the company gives an option, Mr. Bhaumik, either rent-free accommodation in Kolkata. In case rent-free accommodation is given in Kolkata, then 15% of the salary would be considered as the value of the rent-free accommodation. 15% of salary would be 66,000 plus 5,500 plus 12,000. This 48,000 should not be considered. Why? Because it does not form part of retirement benefit. Whereas in case of HRA, lower of the fee should be considered as an exemption. Lower of fee should be considered as a exempted HRA. What is this? Actual HRA amount, that is 1,000 per month, that is 12,000. Number two, 50% of the salary. What your 50% depends on the city of the state. Here, Mr. Bhaumik is taken house at Kolkata, that is a metro city, for 50% of salary. Here, salary means 56,000 plus DA plus commission. No DA because it does not form part of retirement benefit and there is no commission, so it's the 60% of 66,000. Or third limb, rent paid minus 10% of your salary. Whichever is lower should be considered as an exemption and remaining amount should be considered as a taxable value of the HRA. Compare both the options and whichever is showing lower income, that means ultimately that will reflect in your tax bill, lower tax bill. That should be the correct option. Okay. Now this one. Miss Sanjana, an Indian citizen who was working in the University of Kolkata as a reader, deputed to Indian High Commission in UK for a period of 3 years from the first day of April 2022. She should get salary of rupees 7,500 per month, overseas allowance rupees 1,500 per month, rent-free accommodation in London, of which fair rental value is 1,500, a Fiat car for use in DITX free of cost, and actual airfare from Kolkata to London rupees 60,000. She left Kolkata on 26th March 2022 for London and she was paid her airfare there in London. Throughout the year 22-23, she remained in London, compute her income taxable under the head salary for the assessment year 23-24. Can I say that throughout the previous year 22-23, she was in London, so her referential status would be of non-resident, and in case since he is an Indian citizen working outside India or government of employees or government, that situation, allowances and purchasing shall be exempted. Only basic salary would be taxable, that would be 90,000, and the standard reduction of 50,000 is available to her. That means a taxable salary is only 40,000. Be careful in case these three criteria are fulfilled. The assessee is an Indian citizen working outside India as a government employee. That situation, allowances and purchases, whatever be the allowances or whatever the purchases, is not taxable. Here in this example, on the basic is taxable as reduced by your standard action of 50,000. So her taxable salary would be only 40,000. Is it clear? Is it clear? One question is there, sir, for calculating tax under 115 BAC, new tax basis, which amount should be considered as a basic exemption, rupees 250 or rupees 3 lakh? Dear student, for your examination, the basic exemption limit for under section 115 BAC would be 2,50,000. It would be 2,50,000 irrespective of whether you are a senior citizen, you are a super senior citizen, or other category of individuals, whether you are a SCF, AOP, BY, or artificial citizen. Under section 115 BAC, the difference between senior citizen and super senior citizen and other category is not considered. It would be 2,50,000. 3 lakh is considered as a basic exemption limit for next assessment year, that is assessment year 24-25. Be careful, the budget 2023 is not applicable for your exam. Budget 2023 is not applicable for your exam. This is to be held in December 2022. For December 23 exam, the applicable Finance Act is 2022. And for the purpose of section 115 BAC, 2,50,000 should be considered as basic exemption limit. Yeah. Done. Any other question? We have some couple of minutes. So if anyone have any question, please say. From any direct tax chapter of paper 7. You may raise any question. Someone have any question? Any other question? Anyone have any question? No one? Okay. No one have any question? Shall I conclude the session then? Or solve one or more, couple more questions? Trying to provide you one more. Try to solve this one. This one. Question number 3. From the following information, compute income of Ms. Tiwari for the previous year 22-23. Income from house 1, let out 2 lakhs. Loss from house 2, sell for 50,000. Salary income is 5 lakhs. Loss from non-speculative business 3 lakhs. Income from speculative business 1 lakh. Short-term capital loss 60,000. Long-term capital gain 60,000. Here, provision basically is from set off and carry forward. Salary income, inter income would be taxable. 5 lakh is taxable. No doubt about this. Income from house property, first one is income, and the let out loss from house 2 should be adjusted. 50,000 would be adjusted against this income. So net result is 1,60,000. Loss from non-speculative business is 3 lakh. Income from speculative business is 1 lakh. So can we adjust this non-speculative loss with your speculative income? Yes, sir. The set-off is possible. So the net non-speculative loss is 2 lakh. And then short-term capital loss is 60,000 and long-term capital gain is 50,000. This can be set with each other. Short-term loss can be adjusted with your long-term capital gain. Remaining 10,000, what happened to remaining 10,000? Could be adjusted with any other income? No, sir. Capital loss should be adjusted only against capital gain. So this 60,000, this 10,000, this remaining 10,000 should be carried forward to the next year. And regarding this business loss, out of the business loss of 2 lakh, remaining loss of 2 lakh, 1,50,000 would be adjusted against your house property loss, and remaining 50,000 is required to be carried forward. Be careful, business loss cannot be adjusted with your salary income. So in this illustration, the salary income would be the remaining, and total income would be considered as 5 lakh only. Yeah. This was from Finance Act 2023. But since the limit is applicable from 1st April 23, so we are supposed to consider this as a for your December 2023 exam. Leaving, I understood. This 25 lakh is enhanced by Finance Act 2023, but the notification is suggesting that the limit is effective from 1st April 2023. That means after the first day of the assessment year 23-24. So for your examination, it should be considered as 25. Yeah. That means you can say this is a retrospective. Done? Shall I conclude the session? Shall I conclude the session? Any other question? Any other query? Finance Act 2023, it is suggested by Nirmala ji, our Honorable Finance Minister, that limit should be enhanced. CBDT has enhanced with from 1st April 2023. So probably it would be applicable from assessment day 2023, which is for your exam. Done? Thank you. Hopefully you enjoyed the session. I believe there is no question, no query in your mind. Even though after concluding this session, if you have any question, any query, please send me to your WhatsApp channel or Telegram channel, and I will, if possible for me, I will surely reply to your question or query. Thank you. Please try to go through your the amendment hosted at your institute site for your examination, December 2023. Okay. The list of amendment hosted at the institute site, which is that would be applicable for your December 2023. Thank you. In case of any doubt, please share your doubts with me, my WhatsApp channel or through Telegram channel. Please. Okay. Thank you. Good night.